Have you ever wondered how major US banks manage to boost their profits even when the economy is slowing down? Well, let's dive into it. Major US banks like JP Morgan, Wells Fargo, and Citigroup have recently reported profit increases despite a decelerating economy. The secret sauce? Higher interest rates. These elevated rates have allowed these financial titans to charge more for loans, while they've been raising deposit rates at a much slower pace. But this isn't just a story of higher rates. It's also a tale of changing consumer behavior and cautious spending. As the economy slows down, many consumers are choosing to reduce their savings. Citibank and Wells Fargo have noted rising losses on credit cards and other debts as a result. Let's not forget the role of the Federal Reserve in this scenario. The Fed's aggressive monetary policy has made borrowing and debt repayment more expensive for consumers and businesses. Banks, in response, are tightening the credit flow and increasing their cash reserves. This move is partly a response to the collapse of Silicon Valley Bank and two other lenders earlier in the year. Citigroup's CEO, Jane Fraser, has observed this deceleration in spending, suggesting an increasingly cautious consumer. Despite the resilience of the economy, Wells Fargo has set aside more money to cover deteriorating loans, indicating the impact of the slowing economy. While the higher interest rates have boosted net interest income for these banks, there are concerns about the sustainability of this strategy. The banks also caution about proposed bank capital hikes by regulators, which could impact their products and services negatively. So, despite the slowing economy, major US banks are still finding ways to increase profits. But how sustainable is this strategy? Let's continue to explore this in the next segment. What happens when consumers become more cautious in a slowing economy? In a slowing economy, consumer behavior significantly shifts. With uncertainty looming in the financial climate, consumers tend to hunker down, reducing their savings and becoming more cautious with their spending. This behavior is not solely based on fear or anxiety, but is a rational response to the economic changes unfolding around them. As we've seen recently, major banks like Citigroup and Wells Fargo have noted rising losses on credit cards and other debts. This is a clear indication of consumers tightening their belts and prioritizing their financial health. Citigroup's CEO, Jane Fraser, observed a deceleration in consumer spending, suggesting an increasingly cautious consumer base. In response to this shift in consumer behavior, banks have had to adjust their strategies. Wells Fargo, for instance, set aside more money to cover deteriorating loans. This is a proactive measure to cushion the impact of potential loan defaults as consumers grapple with the financial strains of a slowing economy. An increase in consumer loan delinquencies, as reported by PNC Financial Services, further underscores the caution consumers are exercising in managing their financial obligations. This caution, while beneficial for individual financial health, has a ripple effect on the broader economy. As consumers spend less, businesses, in turn, see reduced revenue, which can lead to a contraction in growth and potentially job losses. This cyclical process can further slow down the economy, creating a feedback loop that can be challenging to break. However, it's crucial to remember that this cautious consumer behavior is not necessarily a sign of impending doom. Instead, it's a reflection of consumers adjusting their habits in response to the economic climate. By understanding this behavior, banks and other financial institutions can better adapt their strategies to support consumers and mitigate the impact of a slowing economy. As consumers become more cautious, banks are forced to adjust their strategies. But what does this mean for the overall health of the economy? How do higher interest rates impact a bank's net interest income, or NII, you may ask? Well, it's a fascinating dance of numbers and market forces. When the Federal Reserve raises interest rates, banks can charge more for loans. This, in turn, boosts their net interest income, the difference between the income that banks earn from lending and the interest they pay to their customers for deposits. This dynamic has been at play recently. Major US banks have reported higher net interest income due to the Federal Reserve's elevated interest rates. However, they've also noted that these current levels of net interest income may not be sustainable. Why? Simply put, the continuously changing economic landscape and the volatility of interest rates make it a shifting target. Take PNC Financial Services as an example. Despite the general trend of banks benefiting from higher interest rates, PNC reported a decline in their net interest income. This was largely attributed to increased funding costs, which offset the higher yields they were earning on their interest-earning assets. In essence, the cost of borrowing money to fund their operations ate into the profits they were making from lending at higher rates. Now, let's add another layer to this economic mix: regulatory changes. Banks have expressed caution about proposed bank capital hikes by regulators. Such increases could potentially impact their product offerings and services negatively. More capital requirements mean less money to lend out, and that could lead to a decline in net interest income. So, what's the takeaway here? Higher interest rates can be a double-edged sword for banks. While they boost net interest income, they also increase funding costs and can lead to regulatory changes. It's a delicate balance that banks must strike to navigate these financial seas successfully. How did JP Morgan Chase manage to beat profit estimates amid higher interest rates, you ask? Well, let's dive right into it. In the third quarter, JP Morgan Chase, the largest US bank by assets, made quite a splash with results that outperformed market expectations. The bank's adjusted revenue for the quarter reached a staggering $40.7 billion. Yes, you heard that right. $40.7 billion. This was not only a beat on estimates, but also marked a significant increase of 21% compared to the previous year. Their net income wasn't left behind either. It exceeded projections, reaching a whopping $13.2 billion. Quite an impressive figure, don't you think? One of the key highlights that caught our attention was the surge in net interest income, which saw a monumental increase of 30% annually, reaching $22.9 billion. This boost was largely driven by elevated interest rates and higher revolving balances in the card services unit. Now you might be wondering, how did this happen? Well, JP Morgan's ability to charge more for loans during the Federal Reserve's ongoing rate hikes played a significant role in this growth. And interestingly, they did this without substantially increasing returns for savers with deposits. But that's not all. Provisions for credit losses saw a decrease of 10% to $1.4 billion. This figure reflects net charge-offs of $1.5 billion and a net reserve release of $113 million. This outperformance was beyond analyst expectations, who had anticipated provisions of $2.5 billion. These impressive results from JP Morgan prompted a surge in its stock price during early trading. Even CEO Jamie Dimon acknowledged that these results were boosted by over-earning on net interest income and lower credit costs. JP Morgan Chase's results show that even amid higher interest rates and a slowing economy, banks can still exceed expectations. And there you have it, the secret to JP Morgan Chase's success amid higher interest rates. What does the future hold for major US banks amidst these challenging economic conditions? It's a question that financial enthusiasts and investors alike have been pondering. We've seen an impressive performance from major US banks like JP Morgan Chase, who managed to exceed expectations despite the economic downturn. But what is the outlook moving forward? JP Morgan Chase, for one, has an optimistic view of the future. They are expecting modest growth extending into 2024, indicating a more positive forecast than a mild recession. This optimism is not unwarranted, considering their recent success. However, it's worth noting that this growth is predicted to be modest, suggesting that while growth is expected, it might not be as robust as in previous years. The overall sentiment in the banking sector seems to mirror JP Morgan Chase's optimism. Investors are experiencing what's known as a relief rally. This is when investors respond positively to news that is less negative than expected. In this case, despite the challenging economic conditions, the outlook for major US banks is more favorable than what was initially feared, leading to this relief rally. However, the future is not without potential challenges. One such challenge is the proposed bank capital hikes by regulators. These hikes could impact the products and services banks offer, potentially causing a shift in their business models. It's a change that banks will need to navigate carefully to ensure they continue to meet the needs of their customers while also complying with regulatory changes. Furthermore, there's the issue of an increasingly cautious consumer base. As seen in the behaviors of Citibank and Wells Fargo customers, consumers are reducing their savings and banks are noting rising losses on credit cards and other debts. This shift in consumer behavior could pose a challenge for banks moving forward, requiring them to adapt their strategies to cater to a more cautious consumer. While major US banks have managed to boost profits amid a slowing economy, the future will bring new challenges. But as we've seen, these banks are more than capable of adapting to change.